Good evening, everyone. Good evening, all.
Good evening.
Yeah, very happy to welcome you all to this fifth edition of Banking Matters webinar series that Vriddhi Consulting is hosting in association with SIBSTC. It was the initiative of SIBSTC to have a webinar every month to discuss on the most current and relevant topic that will be useful to the banking fraternity. So we started the session, sir, and we have completed 4 sessions, and this is our 5th webinar. And most appropriately, we can somebody mute? Oh, yeah. We decided to have our session on the most Princey, can you mute? Who is there? Hello. Take care, Princey, please. Hello. Princey, you can start recording. No issues.
So it's recording.
Okay. Now, so this is a very relevant current topic which is to be discussed, and I got requests from many of the bankers that it will be interesting to hear from the leaders what they think about it, how the banking industry is going to take this challenge, what is it going to be important for the liquidity risk management, credit risk management, and how the future is going to be. A very important topic. So we have Mr. KLSN Rao, sir, to make a brief introduction about the topic that we are going to discuss. And I welcome KLSN Rao, sir, and the birthday boy today. Wish you a very happy birthday to you, sir.
Thank you, sir. Thank you, sir.
Special day to Mr. Rao.
Yes.
So
we have none other than Professor Dr. Rajiv Kishore Dubey, former CMD of Canara Bank. He's the most appropriate person who can talk about this topic because he was heading a big bank. He will know the implications of that. He can frame his thoughts for a great discussion among this group. And the moment we discuss who should be the speaker, KLSN Rao told me that why can't we have Dubeyji? Why don't you try to talk to him? He readily agreed. Thank you for being with us, Rajiv Dubeyji. Thank you. It's our honor that you are here with us today. Welcome, sir.
Thank you, sir. Thank you.
Yeah.
So I also welcome ever supporting and vibrant Tangsale ji, former CMD of Central Bank of India, who was also ED of PNB. Welcome, Tangsale ji, sir.
Thank you so much, and my best wishes.
Thank you very much, sir. Sir, we have Mr. Shivan JK, CMD of Dhanlakshmi Bank, here with us today. And welcome, Shivan, sir, for the session.
Vijay sir, good evening. Very appropriate topic for the times.
Thank you very much. And we have Mahabaleshwar sir, Shara sir, who was very supportive for this initiative, who asked us to continue this every month, and his support was a very big motivation for this. Mahabaleshwar sir, CMD, Canara Bank with us. Welcome to you, sir.
Thank you very much. And we have a celebrated speaker today in Dr. R.K. Dubey. We are very eager to hear him.
Yes, sir.
All the best.
All the best. And I welcome all the faculty of SIBSTC and all the senior bankers, senior executives, other bankers, banking friends from the banking fraternity, professors and professionals for this webinar. And with this, may I request Princey to introduce our speakers.
Thank you, sir. Good evening, everybody. Once again, a warm welcome to Banking Matters Webinar 5. May I take this opportunity to introduce our chief speaker for today, Professor Dr. Rajiv Kishore Dubey, former CMD, Canara Bank, partner at AJMS Global Consulting, and advocate and managing partner, SNS Legal. Dr. R.K. Dubey has also held the office of Executive Director of Central Bank of India. He started his banking career with Punjab National Bank in November 1977, first as a management trainee, and then rose to the level of GM after working at different levels in operations and administration across India. During his tenure in Canara Bank, he turned around the bank in 2 years, galvanizing the entire staff, turning focus on retail banking, SME banking, and technological advancements. We welcome you, sir, to this webinar today.
Thank you.
I also take this opportunity to welcome Shri KLSN Rao, sir, Principal, SIBSTC, whose pioneering spirit and enthusiasm has paved way for the success of all the banking series webinars. Thank you, sir. I also welcome Shri Ajay Kaungal, Managing Partner VRDDHI CTS, whose dedication, willingness, and perseverance has made VRDDHI a phenomenal success today. VRDDHI CTS is an initiative that resonates with stability and growth and engaged in offering consulting and training services to individuals, corporates, MSMEs, and startups. VRDDHI is engaged in project consultancy services, mentoring SMEs and startups, and conducts online classes for JIB and CIB examination. I also welcome all the participants who are in this webinar who are also watching us online on YouTube. Welcome, everybody. Thank you. Thank you, sir.
May I request Mr. KLSN Rao to present the topic for the today?
Yeah. Good evening, everybody. And the topic is liquidity risk management, which has been a talk of the world, not only India, across the globe. We are seeing how liquidity crunch. In fact, in India too, a few years back, just about a year back, all of us were speaking of the interest rate on deposit is low because of a huge liquidity position in the banking system. Suddenly the table has turned. Now all banks in competition to increase the deposit rate. Now the credit growth is also substantial. To talk on this, in fact, even the Basel Committee also has recommended two vital ratios, LCR and NSFR, that is liquidity coverage ratio and net stable funding ratio. They have visualized that there could be a problem of liquidity not only in India, in the global environment. Therefore, they said, in fact, I was one of the person feeling that how in what way it could be relevant to India, but now it has become relevant not only to India and global. And on this topic, it is best that we have Dr. Dubey to speak on this. The reason is, Madam said Dubey has turned around the bank. In fact, I am a witness to that, Madam. Let me tell you, Canara Bank is a great bank, a giant bank, but somehow there was a lull. But the moment Shri Dubey took charge, he really made people to work and he galvanized the entire workforce. And in a matter of 3 years, he increased the business and made it one of the strongest and the best bank in the country. So thank you, Dubey, and you are the right person to speak. And I don't want to waste time talking something else. So over to you, sir. Thank you, welcome, and thank you. And then over to you, sir. Thank you.
Thank you, Mr. Rao, and congratulations and many happy returns of the day to you. Happy birthday. I'm thankful to you. I'm also thankful to Mr. Ajian, dear respected Shri Tangsaleji, my earlier boss in PNB and Central Bank of India, and my good friend for last more than 30 years. Mr. Shivan, Mr. Mahabaleshwara, and all dear friends. I am really privileged to get this opportunity to talk to you based on my experience, based on some recent newspaper clippings, where in a forum in Mumbai, SBI chairman, Mr. Dinesh Khara also talked about this subject, and also some of the friends, Mr. Rao and others. So I got some inputs from here and there. Based on my experience, I collated and I thought, let me share my thoughts with you. Well, the topic is liquidity risk management in banking today. Liquidity is extremely important. Just a little background for a financial institution like bank, as it must be able to meet its cash needs as they come due. Liquidity risk arises from our potential inability to meet payment obligations when they come due, or only being able to meet these obligations at excessive cost. Kindly mark the word, meet the obligations at excessive cost. For example, decline in deposits, that is liability, or rise in withdrawal. As a result, the bank is unable to generate enough cash to meet the obligation. This was amply shown by the global financial crisis of 2007-8. Causes of present liquidity condition: just domestic developments, excessive credit demand post-COVID suddenly in the country, the back demand coming in a big bang, low deposit growth, high inflation, high oil prices globally, dollar strengthening, weakening rupee, rising interest rates, and relatively tight money policy these days. Gone are the days of excess liquidity. Global developments, high oil prices, Russia-Ukraine war affecting the whole world. We don't know when it is going to stop. High inflation across the globe to the extent of recession looming in USA, Europe. UK condition is very bad. Inflation is touching double digits almost globally. Uncertainty globally, dollar strengthening all around, and low growth. Now, this is the scenario throughout. Average daily absorption under liquidity adjustment facility given by RBI. Rupees 1.35 lakh crore and rupees 2 lakh crore during October and September 22. Average net durable liquidity injected into the banking system in April 22 was 8.3 trillion, or you can say 8.3 lakh crore, which has now fallen to only 3 trillion, 3 lakh crore. Call rates are zooming. CDS increased from 0.57 trillion to more than 2.41 trillion rupees. Total borrowing of banks increased from 2.74 trillion in rupees as on 25th March 22 to 5.49, more than double trillion as on 21st October 2022. Now, this is the position of liquidity adjustment facility right now. Primary sources of liquidity for a bank. Let us just count. Cash and treasuries, retail, the low cost deposit, CASA, and wholesale term high cost deposits, certificate of deposits, what we call CDS, trading book liquidation, securitization, borrowing ability of the bank, and central bank borrowing. Now, these are the sources for liquidity for the bank. Coming to CD ratio, it has been hovering around 73 to 75%. For some banks, it is 90% plus. For some banks, it is 65% plus. But the average is around 74% in August 22. This is also a cause of, I don't say worry, but liquidity. Credit and deposit growth of commercial banks, how it has gone in the last few months. 15% plus YOY credit growth in August 22, which is 9-year high since November 2013, when it was 16%. Now only we have reached November 13 level when I was in the bank. Now 17.9% in 2 months, October. From August to October, 15.5% increase to 17.9%. 2 percentage points credit growth is quite high against 6.8% last year, while deposits grew only 9.5% in October 22, creating a huge gulf in resources. 16.9% YOY credit growth in November 4, the latest figure 22, while deposits grew only 8.2%. Just double is the credit growth. You can well imagine deposits not growing, practically stagnant, rather going down, hovering around 8 to 9%. Credit is around 16 to 17%. Now, this is the problem that really is creating the things for the banking. Now, how banks tackle the liquidity stress till now? Drawing down excess CRR balances and non-SLR investments by some banks depending on their portfolio. Certain banks also took recourse to MSF, the margin standing facility. As you all know, it is a provision made by the RBI through which scheduled commercial banks can obtain liquidity overnight if interbank liquidity dries up. MSF rate is a rate at which the commercial banks borrow funds overnight from RBI. Now, this is zooming, causing concern. The present liquidity situation, some say it is transitory in nature. Transitory means it is a temporary phenomenon. I can't comment which is exactly because of the uncertainty looming around. Could be partially transitory, could be it may be there for some more time. The situation of liquidity strain is likely to be transitory or for some time down after the festival season. Especially, after the festival season, there is a change. There is a, definitely a change happening. The leakage due to currency demand likely slowing down after the festival season. The government expenditure is likely to pick up, hopefully, because government is committed for capex, as also the corporates. The pace of forex outflows has moderated, which augurs well for the system liquidity. Deposit growth of banks likely to pick up, hopefully, with more thrust in coming fortnights, especially when more interest rates are being offered now in saving, in term deposits, in high-cost CDs. Banks have adequate cushion of SLR to meet the potential liquidity requirement. Market forces will also eventually, stabilize. Now, this is a very optimist point of view regarding liquidity, that it is transitory. It can be transitory, it can be moderated, or it can be there for some time. Liquidity risk management way ahead for bankers. The deposit rates are likely, the first important thing is deposit rates are likely to increase to help liability accretion and fund credit growth. Banks would need to compete for deposits, the same available deposits in the market, to support their respective credit growth. Why I say respective credit growth? Every bank's position is different, their deposit is different, their CASA ratio is different, their needs are different, their spread is different, their NIM is different. So they have to do as per their cost of deposit and yield on advances and what their ALCO says. Saving rate. Now, if saving rate is not increased, when the liberalization happened in saving rate, they went down up to 2.5, 2.75%. Still, many public sector banks are keeping it at around less than 3%. Private sector banks they are around 6 to 5 to 7%. So a little play in saving rates will enable banks to maintain the CASA. Otherwise, shifting of deposit will take place from saving to term deposit. But if it is not done, there could be flight, or there could be flight to other banks. So saving rate is very crucial. Every bank has to think whether they have to increase saving rate or at what level they have to keep saving rate, going to term deposit rate. They have already started moving up, ranging from 5 to 6% to 7+%. I would not be surprised if in the near future they are around 8% or even plus. CD or high cost deposit, those who are near their CD ratio 90%, 80, 85%, they are going for high cost deposit and offering differential rate on bulk deposits. Now, what will happen of this much of deposit competition? When the cost of deposit will go up, profitability and NIMs would be affected. Impact, high cost on profitability and bottom line of the banks. Now, this may be the cost banks may have to incur in order to meet credit needs. Credit needs are growing and they are likely to grow. I'll touch in detail this particular point regarding credit growth. The rise in lending rates may not be able to keep pace with an increase in deposit rates, impacting the net interest margins. RBI, though, has assured liquidity support, but it may come at a cost. It would not be as easy as it was 6 months ago, 1 year ago, 2 years ago, when banks were parking funds in reverse repo. Now they don't have funds even for lending. Now, what in this scenario, what banks need to focus on? Now, this is important. What are the thrust areas for the banks? Improving customer service further, helping in raising resources, improving operational efficiency of the digital infrastructure so that a customer doesn't move to other banks. Otherwise, nowadays, customers don't threaten. They go to those banks where convenience is more, service is better, and digitalization is better. Alignment of interest rates with different types of deposits is likely to be happening. You know, in the credit policy that is likely to be announced in the first week of December, there is an expectation, as suggested by the economists, that 20-25 basis point to 30-35 basis point increase could be there again in the repo rate. If it happens, that will again have an impact on the deposit and interest rates in the market. While being conscious of ensuring liquidity, credit risk also to be carefully managed while exploiting the credit offtake, because credit offtake is likely to be around 15% plus. This is my guess. Now, if it is 15% plus and deposit rate doesn't go up, there is going to be little mismatch continuing for some time. Now, for that, you know, a lot of things have to be done. As a result, when the interest rates will be increased for credit, the corporates, what will happen? They may go slow, but entrepreneurs may find it difficult to fund their, business, especially the MSME borrowers and the startup. Now they are not getting funds easily as they were getting in the past. Investment plan, they have to take care of it. Unless they have a good and stable credit rating, they may not be able to raise funds. And credit rating of borrowers can't be earned quickly. They need to build over a period of time with conscious credit discipline. So likely sufferers could be the entrepreneurs, the MSME borrowers, the startup industry. Therefore, one has to be very careful while increasing interest rate beyond a point, and also to decide to lend to only high credit rating borrowers. It is good that credit banks lend to high credit rated borrowers, but there could be certain issues in that. Now, coming to the forecast, what is the forecast? I am not telling you the source, but the forecast is annual capital spending of India's 15,000 largest industrial companies is likely to be 4.5 lakh crore, that is $55 billion in financial year 23. Next year, capex is likely to be 4.5 lakh crore and 5 lakh crore in each year. That means financial year 24 and 25. Now, this is the likely capex cycle in view of what? In view of Amrit Kal. There is a Amrit Kal being announced by the government in the last budget. Next 25 years, the Amrit Kal synchronizing with 2047 to fund $111 trillion of infrastructure projects. Banks capital markets, gift city, and government capex will have to play an important role. Government should evolve ways to share risk and also support hand-holding for funding infrastructure and large projects. The new institution of infrastructure financing has to move faster. Infrastructure-led growth propelled by PM Gati Shakti, the national logistics, warehouses financing, as has been planned recently, 20,000 crores guarantee fund will be created, and infrastructure pipeline is likely to be there. What is going to be there? This is really a different scenario than what we had seen in the recent past. Look, the credit risk management has to be robust, and it has to be underwritten well, and it has to be priced well adequately. Then only companies to put more money on the table. Gone are the days of leveraged companies. Some 10 years back, the deleveraged has already taken place. Robust credit management, robust credit monitoring system, robust risk management system, infusing compatible risk management skill sets on a sustainable basis instead of taking ad hoc measures to deal with stressful times in the banks across the board to all the staff members. That sensitizing staff is also very important. So the risk culture has to go down further. Continuous focus on maintaining good asset quality. Somehow now we are in a little better position in comparison to last 5-6 years ago, when NPA level had gone to 10, 15, 20%. It has come down to a reasonable level, and good asset quality, gross and net NPA down, focus on recovery and OTS of the banks have to continue without fail. It has not to slow down, because that will also fund them, make funds available for credit growth. There are two big sources which are available now for the banks. One, government spending in the future, and excess SLR to support credit growth and also the economic growth. A lot of funds are there in SLR portfolio of all the banks. Almost 2.5 to 3 lakh crore of government's balance is with RBI, which is unspent. Roughly 3 lakh crore, that means 3 trillion of government's balance is with RBI, which is unspent. Now, the moment this comes to market in the coming 4 months and in the coming financial year 23-24, we are really going to have improved liquidity. Next, important source, surplus SLR with the banks. Almost every bank who had surplus SLR because of low level of lending in the last 7-8 years, SBI alone, as their chairman, Mr. Dinesh Khara, gave this figure in the recent conclave at Mumbai, SBI alone has 3.85 lakh crore in excess SLR undrawn. Now, if only SBI has 3.85, roughly 4 lakh crore, all other banks put together, even if they have 4 lakh crore, so it comes to 7-8 lakh crores, and 3 lakh crores government having in RBI, roughly 8 to 10-11 lakh crores of liquidity is likely to be there. So I personally feel a proper management of funding, liquidity management by each bank would enable them to tide over the difficult period. Banks whose CD ratio goes higher than 75% will have to raise resources at high cost. SBI chairman told their CD ratio is 65%, and chairman felt till 75%, they feel no problem at all. So that much of strength they have. I personally feel most of the banks post-merger have, if not similar, really good position. Sustaining loan growth won't be a challenge if risk is assessed well and priced adequately. Lenders have learned from the past. Insolvency law is there. Corporates are now afraid of losing company. What corporates felt 10 years ago that they will get away. They said that not only equity is required, the color of the equity is required. It was admitted that the projects were funded earlier not by equity, by hybrid debt. Now gone are the days. The banks would like upfront equity and more contribution from the promoters. SBI has given data that they have pipeline of 2.5 lakh crore of projects for funding. Now this much they have projects for funding and 3.85 lakh crore liquidity they can draw from non or excess SLR unspent fund. So they feel no problem. That means the biggest lender is not going to have any crisis. Similarly, if every bank looks inside and does analysis, I feel they may feel some comfort out of this discussion. Country saw fresh investments to the tune of 20 lakh crore, out of which 70% crore in project forms only. That much of investment has gone through in the recent past. And what is the prophecy for the future? In coming year 23, 12 lakh fresh investment is likely, 12 lakh crore. And after that, again, 15 lakh crore every 2 years. What are the thrust areas which are being found for lending? Listen, my dear friends, banker friends, some input I am giving you. Infrastructure, the biggest area for funding. Manufacturing, and banks have learned from their mistakes from lending to infrastructure. Now the mistakes will be relatively not there. Manufacturing is happening. PLI since 2021, production linked incentive scheme is there, giving help to the sector which need thrust. Housing, government housing, private housing, consumer goods, tourism, real estate which was lurking, in last 5-7 years is slowly coming up in NCR, in Mumbai, in Bangalore, in good market. Iron and steel, a lot of incentives are given for iron and steel also. Some new economy segments, they have emerged, which were not there earlier, like data centers. A big financing to data centers taking place because of need of data law, data privacy law, which is likely to be coming maybe next year. Electric vehicle financing, a lot of electric vehicle makers are coming, which were not there 2 years ago. And chip makers are also coming in a big way. So they also need finance. A big financing is taking place along these sectors, and therefore everyone has to look forward for more opportunities which are there in abundance for credit growth. So everyone has to gear up to generate resources. Now, as this is another new area I am suggesting, which is not new, but many people have not availed it, not used it. What is that? This is opportune time for Secondary Loan Market Association. I am repeating, Secondary Loan Market Association. In brief, it is called SLMA, formed by 10 banks. It is an online platform formed by 10 leading banks in August 2020 during the lockdown to activate secondary sale of loans, to rejig risk appetite, and to ease the stress on liquidity. A very big source for this particular stress liquidity time of using SLMA, which are the 10 banks? SBI, ICICI Bank, Stanchart, Kotak, Canara, Axis Bank, Bank of Baroda, PNB, HDFC Bank, Deutsche Bank. They are all there, and it is a body that regulates the secondary market for corporate loans, and the SLMAV was formed on the basis of recommendations of RBI task force on the development of secondary market for corporate loans. Many people have forgotten. This is there, my dear friend, and this is the time where it has to be done, used. Axis Bank took lead. It has taken the lead to sell loans worth 1,000 crores recently through SLMA platform, a move that needs to be strengthened. Those banks like Shivan Saab are there, Karnataka Bank there, they could tie up with these banks, maybe Canara Bank, SBI and other banks who are not interested. They could offload their portfolio, sell their portfolio, and then generate liquidity. This is an opportune time to use SLMA. They could become member also. Now, banks can factor floating risk adjustments, pricing aligned to credit rating to achieve the targeted yield. The floating risk adjusted pricing aligned to credit rating to achieve the targeted yield. There is a time now that we incentivize, banks need to incentivize with better compliance. Those borrowers, those companies, those corporates who are doing better compliance and observe credit discipline, they can be a better value proposition by giving them some incentives instead of curbing lending to good entrepreneurs having weak credit rating. Now, this is a hint I am giving that some incentives even small medium banks can think to support such borrowers who are regularly paying the money back to the banks. Now, important things, why banks feel relatively better now. The ecosystem that has developed in the last 5-6 years, there is a GST network. There is a property registry, SIBSTC, rating system strengthening. One rating company has been given notice also by SEBI, which is already in the court. Creditable data is available now for evaluation is there. Sustainable credit growth by banks is possible now. Banks are much better placed in the risk assessment than 5-10 years ago. Corporates are deleveraged. One important factor is provisioning is between 80 to 95%. I found, I would not name, some banks provisioning is 90 to 96%, and even for the banks 80 to 85%, they are better placed to sustain further credit lending, and therefore I think there is no fear everyone should have for lending. The better credit management, the better credit monitoring system, the better risk management system would help them do that. Now, the last point I would say, there is a time for strengthening governance. Something regulator says. I am, just advising my dear friends, banker friend, Asset Liability Committee, ALCO, needs to sit every month and needs to, assess periodically, right now monthly or bi-monthly, results of stress tests and on the liquidity risk profile of the bank to Board of Directors and Risk Management Committee of the Board, suggesting short-term and medium-term remedies. The Board of Directors and top management of the banks to ensure management of liquidity risk by deciding appropriate strategies, policies, procedures to manage liquidity risk in accordance with liquidity risk tolerance limits of their respective banks. The risk tolerance should be clearly understood at all levels of the management, senior, medium, middle, and the junior. The board of directors need to have liquidity risk profile, not only of the bank, all branches, especially credit trust branches, the large, credit branches, the mid corporate branches, the large corporate branches, subsidiaries and associates, both domestic and overseas, should be periodically reviewed and formulate contingent funding plan for their respective bank. Now, this is very important. Treasury unit, what needs to be governed, strengthened, in addition to ALCO, the first line of defense after ALCO is Treasury unit. My friend, I see Dr. B.L. Patheja has been expert of ALCO in PNB, my earlier bank. The Treasury unit, the first line of defense to be strengthened. Risk management department, the policies, the second line of defense. Continuously stress test to be done for portfolios. Internal audit system, the third line of defense. Now, if these things are taken care of the banks, I see no reason that they would be able to find ways and means to handle the present liquidity position or the tough situation which is likely to be there on a sustained basis. You know what somebody has said, the first $1 trillion GDP took about 50 years in India. First $1 trillion GDP took about 50 years, and then $1 trillion added every fifth year. From, if we have to go up from $3.3 trillion to $40 trillion, we have to be aggressive on every area, and banks have to play proactive role in development of the economy, development of the country. This is a golden opportunity in Amrit Kal to take the country to number 1 or 2 in the world. We need to take care of digital, green economy, environmental friendly, taking care of climate risk, and G20 leadership gives this opportunity to the country, and banks are very important, tools for taking care of the lending needs of the economy. All segments, top corporates, mid corporates, entrepreneurs, startup, retail, and every segment of society. I think I have done justice to what I was supposed to talk. Now I'll leave the matter for questioning by the audience.
Thank you, sir. Thank you, Thangsaleji, Dubeji. It was a wonderful, in-depth analysis of the old situation, and while you are presenting it that this is a transitory stage, and we have a positive and you are very positive and optimistic about what's going to happen. You very clearly presented, analyzed, and also gave the impact which is long term and short term, and which are the thrust areas and the forecast that is going to have done in a nutshell. Wonderful, sir. And you rightly touched the other critical points also. Well, many of the variables are beyond the control of the banks. There is one variable which is always under control. That is our customer. That is something you very well focused. And you said that's the main thing that we should focus. And you also very rightly pointed out about the skill sets that is required. Much talked about the skill set, how to develop the skill set of our internal customers, and you focused on the governance and also the SLMA and the floating risk, and also you mentioned the ways how we can manage the liquidity situation now. So elaborate this your recording will be a very good learning session for all the bankers, sir. And I opened this. I'm not taking much time. I'm not asking any question. I am opening this for discussion. Participant can unmute and
before that, Vajayanji, I only wish during the Amrit Kal, our Dubeji should have been the CMD of a bank, because I know the nature, the aggressiveness, the way he spoke of aggressiveness. He is really an aggressive banker. Wish that he should have been the CMD of the bank for next 25 years to 2047. In fact,
Ajay, yes, I just wanted to really, because although I moved out, but I did not remove my, because Dubeji was really putting the things in the right perspective.
Right.
And I just want to add 2-3 things to what he said. One is he made a reference of 2008. And honestly speaking, all of us remember that 2008-9, we were flush with funds.
Yes.
And you might be aware that the highest deposit rate was 6%. The high cost deposit was almost zero. Corporates were chasing, and we got into heavy lending to the infrastructure sector. And there we thought that somehow liquidity should be put to use, and we got into a lot of problem which we have faced for last 10 years.
Yes.
I think 2012 to 2022, everybody thought that the bankers do not know the banking, which is not a reality. The reality is that the country needed the infrastructure. We invested in it because we had good liquidity. I think Dubeji brought the right point that you have to be very cautious of the cost part and the yield part.
Right.
And if you really do very cautious selection of a composition of your assets and liabilities, and do not look at only the high credit rated, but make a mix of it, put the proper pricing for the credit risks which are taken. But more than that, I'll only add one thing for the participants, that today the credit risk management is one of the most important point which every banker has to understand. Credit creation is much easier, but credit monitoring is very important. And the banker will have to engage with the credit life cycle of a borrower to make sure that you are not only a lender, but you are a partner in business, and you are making that enterprise productive, working, and generate your money, whatever yields you wanted to take out of it.
Sir,
so I was.
Sir, do you remember? We created credit monitoring department in Central Bank of India in 2012.
Absolutely.
And we brought 2 general managers,
correct.
separate vertical, first time in the banking we created. And
very
in Canara Bank, I created 3 verticals. Credit management and monitoring, up to 10 lakhs to 100 crores and above 100 crores. We did that particular time. So this is the need of the hour on a continuous basis. Ongoing basis. Thank you, sir. Thank you for that.
So I thought that I must add these points. And with these words, Raju, once again, compliments. And I would like to take exit now. I am with my friend's place. Thank you so much. Thank you. Thank you, Ajay. And thanks all the participants.
Thank you, sir. Thank you very much.
Thank you.
Shivan, sir, you want,
So we always tell that, Dubey sir put it so succinctly. The biggest fear is when there is a liquidity overhang. If you see the major mistakes committed by banks is when there is liquidity pressure. There is excess liquidity. Now we have the real opposite situation where we feel that liquidity will evaporate and suddenly all of us will be left in the lurch. But, Dubey sir actually referred to Mr. Kara's statement. It's really, really heartwarming to hear such a statement that there is no big crisis. There are government spending there, excess SLR there, it's not like a crisis situation. Because I remember I was in London in 2008 when Lehman happened. Why did Lehman happen if you look at it? Always because of excess liquidity. Then, we start reinventing how to redeploy, how to get a better margin. And here actually there was a lull now because in 3.35% repo, no other choice but to put in repo. And then so slowly slowly we started putting into 5%, 5.5% bonds, AAA bonds. And so many of us are bleeding because AAA 5.5% is nowhere. We are having 6.5, 7.5, 8 and even beyond. But it's every aspect Dubey sir has touched, including the secondary loan market. India, probably, I don't know, we are very much attached to assets. We don't know how to detach ourselves from assets. Maybe that is a cardinal reason why loan market is not, developing. Loan market is a great indicator also about what is the perception about a loan. So that also it's a very good thing to have. I hope the market also develops in the future. But wonderful presentation, sir. Like every word that you have written, we have noted down, sir. You have mentioned, we have noted down. Thank you so much, sir.
Thank you, sir. Thank you. Anyone can unmute?
I'm Rajkumar here. Can I speak?
Rajkumar, sir. Yeah. Please.
Dubeyji has made a very good presentation. But one or two points which I wanted to highlight is the two causes for rate of increase, increase in rate of interest is one is repo rate pricing, and the other one is liquidity. Credit is much more than the deposit. That is liquidity problem faced by the bank. Regarding repo, it has been increased from 4% to 5.9% for the last 3-4 months. Now there is an indication that in the last month, the inflation, actually repo rate increase is mainly for containing the inflation. Repo rate has come down slightly. Inflation has come down from 7% to 6 point something. So it is to be seen in the December meeting of RBI whether they will increase or they will keep as it is. So that is a possibility is that they may not increase if the further fall is happening in the inflation index. The second issue is regarding the liquidity issue. I think the deposit growth has been very less, mainly during this COVID period, during which 3-4 years the interest rate has been at the lowest level. Many people have, there are a lot of new entrants to the stock market during this period because the bank interest was very much less. So they engaged into stock market. So what is to be understood by all the banks is that unless there is a reasonable return for the deposit, increase in deposit may be a little difficult. A slight increase will be required even if repo rate is maintained as it is. Otherwise, bank will have to resort to their own excess SLR or repo from borrowing under repo from RBI. This is what I feel. My point is banks have to take care of the depositors also in the due sense of the customer term. That's all. Thank you.
Thanks, Mr. Rajkumar.
Sir, can anybody to present their views or add on to this? Pateja ji, anything, sir? Okay. Dubeyji, one thing, though you very positively presented, two things that is still striking me is the concern about MSMEs and startups.
Yes, I am concerned.
Yeah, we are very well still on, even though we have taken lots of steps to focus on this MSME segment, especially the micro segment.
Right.
Yeah, which is the major group impacted by various fluctuations also. So we still know that in spite of all this, as per the World Bank reports, there's a still gap, lending gap still remaining to be filled. With that gap still remaining, with all these things happening, how that segment will move, and with the recession that somebody is going to, each country has its own problems now. It's not economy as such for the whole the country, but different countries have their own problems, and we all feel that recession is going to happen. What will be the impact? Not only the MSME, we also know that the startup ecosystem is booming now. Lots of startups are also coming. Will these two have some impact? Just
I have already covered in my presentation that these two are likely to be having some difficult period, and for that, Reserve Bank and government have to proactively come out in support, like they have come out during the COVID time. The ECLGS support, where government guaranteed trade was allowed, and I found government was more forthcoming than the commercial bank. Because I was interacting with many borrowers, many banks, I found banks were not as liberal as they should have been. They need to be compassion. They need to have compassion for such vulnerable sections of society, for those startups
who are young boys and girls with new ideas. They are their children. And those poor micro, small borrowers, I think banks need to have love, compassion, and duty, sense of duty towards them. And government and RBI should formulate some specific strategies for this sector so that they don't suffer at all. I am very clear this is likely to happen, and maybe in a sustained basis when warehousing financing, real estate financing, infrastructure financing, as per the Amrit Kal, is likely to be there, for big project financing in the coming decade or so. Then these small startups and MSME should be especially taken care of, because I am not worried about the retail sector. All private sector banks are doing financing to retail sector. Even public sector banks are jumping. So retail is not a problem. MSME still is a problem even now. And with the money availability tightening, unless RBI and government takes proactive steps in various ways. There are various ways. One is interest rate. Maybe they give, incentives like they do for agriculture in the rural areas. 1%, 2%, 3% incentive. Something extraordinary will have to be done by the government and the RBI. You are very clear. You are very correct. I agree with you.
Thank you, sir. Thank you.
Sir, Ajay,
yeah.
My one last question to Dubey, sir.
Yeah,
sir, what about agriculture sector, sir? Agriculture, Dr. M.S. Swaminathan says, going forward, we should supply food to the world, and by providing food to the world, we have to rule the world, not with guns, but with grains. This is what M.S. Swaminathan
says. I personally feel agriculture continued to be the thrust area of the economy, of the banks, of the government. I don't think it is likely to suffer, because government has inbuilt systems of incentives to be given. And the rural agriculture branches, the small finance banks, the postal banks, which will be maybe converted to small finance bank or universal bank, I personally see not stress to agriculture financing as it is for MSME and startup. And therefore, government will have to take care of all these areas, because when they are taking care of infrastructure financing for a zoom in the growth, they cannot ignore these vulnerable sections of society. You are very correct. Agriculture, MSME have to be taken care. I even say education loans may suffer, so it should also be taken care. It is very important. I have told one thing, sir, unless compassion is there with the banks, I feel this is lacking. Not with all, many. They feel, money is going down the drain. No, it is useful also. We need to have compassion for the younger generation, for the students who are our children, for the poor people, for the agriculturists, for the startups ecosystem. Somehow it has come up in a very nice way in the last 3, 4, 5 years. The momentum needs to be sustained, and liquidity crisis should not affect them at all. And therefore, bankers need to be having compassion, love, and really proactive for helping the sectors of the economy which are helpful for the development.
Thank you, sir. Mr. Shyam, please.
Good evening, sir.
Good evening.
I just had one doubt regarding this credit uptake. Say, for example, nowadays, if you see MCLR, the pace in which RLR is going up is more faster than MCLR, as RBI is hiking the rate, and secondary market also money is flowing. So banks will have challenges in getting the retail main core term deposits in the coming next decade. What is your opinion about that, sir?
I have already covered this point, that they will have to chase the same deposits, and maybe for that they keep on increasing rate, increasing their cost of deposit. But then there are various sources. I told you the government has to spend more. One, they have to use their accumulated SLR funds. So that liquidity people are not taking care of. If that is taken care of, I think 5-10 years can easily be taken care of. And by that time, situation may improve also. Economy may improve, market may improve. Let us not be pessimists. Ukraine war will end someday. You don't know when. Maybe 1 month, maybe 10 months, maybe 3 months, it will end. The moment it ends, a lot of things, the side effects will settle in 3 to 6 months. I am optimistic, and we need to be optimistic that a bad situation may not be there for a very long time. Things will improve.
Thank you, sir. Any more points? We will take one last question.
Thank you, sir.
Anyone more? Thank you. Okay, sir. Thank you very much, sir. We had a very detailed discussion. And Shivan, sir, you want to contribute anything more, sir?
No, I'm okay. I'm so wonderful to hear.
Okay.
Actually, it's the first time I am logging in. I never knew it would be of such high standard. So I regret that. Actually, Mr. Rao had especially told me, don't miss this time. So
thank you, Mr. Shivan. I am grateful.
But I'm logged in, and then it was wonderful to hear.
Thanks a lot.
So no more questions. Anyway, no more questions, I think. So we'll conclude before Ravindran. You want to say something, or we'll close? Dubeji, because just to give a wide thought, because with the digitalization happening so much, with technology happening, fintechs coming up and playing a big role, is it not time that we still shift away from our classical type of lending, and we have new lending models in different levels of lending, equipment lending or something, and we focus more on, we have lots of information for every trading. Is it not time that we think about?
Yeah, you are right. You are right. The point is, see, they say necessity is the mother of invention. When there's a need, it happens. But then, the way apps have been used, chasing the, Chinese apps in lending, and a lot of exploitation took place. And this fintech RBI has come heavily. So we need to be slow. We need to take care of the, those aspects also, that somebody can hijack this also. So I think we need to respect the regulators, because ultimate sufferer also the common man. Therefore, let it go a little slow. This particular thing may be slow, but then it will evolve. Indians are very, very innovative. They have proved their worth globally. So I am optimistic that more products, more schemes, more new things will evolve as, the Paytm and, the payment system has evolved in the country, which is the best in the world, perhaps. It will evolve.
Thank you, sir. Thank you very much. Rao sir, can we?
Yeah, we can close. And I seek permission of Dubey sir that this talk would be used in our classes, sir, when we do a program, because the way you have articulated liquidity management is wonderful. In all our high-end programs, with your permission, put on the class, sir.
Sure,
sir. It will be my pleasure. It will be my pleasure.
Thank you, sir.
We have Agarwal ji and Raina ji also with us today, who have been with PNB also, worked with you also earlier. Thank you, sir.
Thank you very much, sir. Thank you very much.
Thank you, Agarwal sahab. Thank you, Raina ji. My best wishes.
Thank you, sir. Thank you, Dubey sahab. Thank you, sir, very much. So nice to look to this. Listen to you, sir.
Now, Princey, you can.
Yes, sir.
Yeah, please. Let us have a formal vote of thanks, because we would like to have this session go on and on. It's such a very interesting, lots of things to be debated also, but we have to, all good things have to come to an end at some point of time. Yeah, that's it.
Thank you, sir. On behalf of SIBSTC and VRDDHI CTS, I take this opportunity to thank Shri Rajiv Kishore Dubey, sir, for speaking to us today on the topic Liquidity Risk Management in Banking. We thank you, sir, wholeheartedly for sharing your knowledge with us, as well as your valuable presence and time. Special thanks to Shri KLSN Rao, sir, and AJMS, sir, for organizing one more of this successful webinar series, Banking Matters. Special thanks to everybody who joined us on Zoom as well as YouTube. Thank you to all the participants who participated very actively in the interaction. Eagerly looking forward to webinar 6. We take leave. Thank you, everybody. Thank you.
Namaskar. Thank you.
Namaskar.
Thank you, sir. Thank you very much, sir.